this is probably our fifth topic, is not having a budget, not budgeting and forecasting, not budgeting and forecasting in a business. I don't know how people would do that. You know, if you're running your business by the seat of your pants and just hoping that you'll have enough in the bank to pay the bills at the end of the month, that's like, you just hoping that the paychecks is going to pay the bills at the end of the month, which is not the way to do that. You'll wind up with debt. You'll wind up with, more financial responsibilities. You're not going to be able to handle that. So my advice is to develop and stick to a budget forecasts, and I'll tell you a couple of the other reasons why budgets are important when we go over our other topics that you're going to be explained. So one of the things that the other thing that we work on is how all these things intertwine in our financial literacy package, understanding our bad money habits in order to become smarter with our money and make better money choices. They're all intertwined. They're all included. So having a budget helps you in other aspects of your business. So having a forecasting helps you with other aspects. So you want to make sure that that, and also it will help you read your financials, understand your picture. Yes, you budget that you're going to spend $1,000 a month on marketing. Okay, am I on budget with my marketing? That's one thing, but then you dig a little deeper into it. If you're going to be looking at, understanding your numbers, you dig a little deeper. Am I spending this $100 as efficiently as possible, this $1,000 as efficiently as possible? So having the budget starts you off, then digging a little deeper, understanding your number picture a little further is, am I maximizing on my $1,000? So you want to be able to have that. Of course, budgets are flexible. It's something, you want to make sure that, you can use a static budget or a flexible budget, but in either case, it still can be flexible. So, we'll talk about those things and I'll explain that to you a little further. Part of the budget process is you have your fixed costs, your variable costs. There's one-time costs like building of a website. There's fixed costs, which is usually your rent and car payments and vehicle payments and those type of things. Then you have variable costs, which is sometimes your light bill, your utilities, certain things that are variable with maybe the cost of some supplies and things like that, so you want to make sure that those are the things that you look at. One of the things that you also might want to include in your budget is a prospective cash flow statement. So, so you understand cash flow. So the sixth thing that we want to talk about is not having proper tax compliance. When you are poor with handling tax compliance, it can be detrimental. It can end you up in jail. So you want to make sure, you're managing your cash. Cash management is good. You're doing a good job with that. So but you also want to make sure that you're complying with the IRS. Still up to 85% of small businesses, they overpay their taxes each year. You don't want to overpay, you don't want to underpay. You want to make sure that you're paying the right amount because it could affect your cash flow. You want to make sure that, if you're paying too much, you're probably, tightening yourself too much when it comes to your cash flow. So you want to make sure that you're doing quarterly reviews with your tax advisor, so you understand that you are in line with what you need to pay for the year when it comes to your tax. The IRS will charge penalties and interest if you're not paying. If you're underpaying consistently, you're underpaying your taxes, it'll start build up and it gets bigger and bigger. So you definitely don't want to underpay, but you definitely don't, you might not want to overpay either large amounts because you want to make sure that you are using your money wisely as part of your cash flow. One of the other biggest issues that businesses are facing with federal tax isn't payments, is the cost of compliance, which we talked about. The cost of compliance, meaning the high penalties and interest that they're charging you, when you're not doing what you need to do, when you're not filing your taxes on time, when you're not making sure that you're doing, for example, if payroll returns are not filed on time, the fees are so high, it does not make sense not to file it on time, because that needs to be done. Payroll returns are normally done quarterly. So you don't want to waste money on fees, on penalties and interest. You want to make sure that you're doing all of that on time. Payroll companies usually help with that. You want to make sure that you are not being inconsistent or you're not limited with your cash flow. Most people struggle with managing cash flow. I think this is one of the hardest things for individuals who have small businesses, is to manage their cash flow. Understand the manage of their cash flow. Understand that their cash flow is not their income statement or their profit and loss statement. That's one of the biggest issues I see. You all need to understand cash flow is separate. Your balance sheet and income statement is the health of your company. The cash flow is the liquidity of what you have available to use in your business. So you want to make sure that you're effectively managing enough. You have enough to cover your monthly bill. You're accumulating cash to invest in your growth. Liquidity is an ongoing issue. So that's something that you personally, as a business owner, need to be aware of all the time. Maybe you're looking at your financials monthly, but your cash flow is something you need to be looking at more periodically. So I definitely will say that, you need to be managing accounts receivable, accounts payable, making sure that, you have everything on your calendar that affects your cash flow. You want to make sure that you're understanding everything that targets your cash flow. Cash flow 101 involves balancing your accounts, your payables, your receivables, and maximizing your cash-to-cash conversion cycle, making sure that your company is insured the access of the right capital. And we'll get into capital, in a little while. So beyond all of this, you need to make sure that the cash flow is forecast properly. Your historical information is correct, and your forecast information is correct. When you maximize all the cash flow strategies, then you are able to combine them and maximize your liquidity. So cash flow is the liquidity of the company. You, as a business owner, need to have the biggest handle on that statement more than anything else. The eighth thing we need to talk about is not raising enough capital. So when businesses start, you want to make sure that you're raising enough capital. Raising enough capital, what does that mean? That you have the right funding, whether it's debt funding or it's, 82% of business owners that survey don't even know how to interpret their company's credit score. So you want to make sure that, your funding also affects your overall health of your business. Your credit score is just like your business. Your entity is a person is an entity. A business is an entity. When I do taxes for someone, a person with a social security number is an entity, or a tax ID number, that's an entity. When we have a business, that's a different entity. So they have their own filing requirements. So every entity, whether it's a person, a business, a trust, an estate, they all have their own filing requirements and their own things that are required for tax compliance. So you want to make sure that you have an understanding of your business credit score, and that you are able to get approved for loans when it comes to the time. Your credit score involves you paying your business bill on time. It involves your how your cash flow is working, and it involves your accounts receivable and your accounts payable. So the overall health of your business. You want to make sure that you're looking at that. So there are different types of funding that you need to look at. SBA, which we are going to go into, lots of the different private fundings, venture capitalist fundings, you as the individual putting your funds in there, bank loans, they're all personal loans. There are all different ways that you can get your companies funded, and, and understand how much funds you need, and making sure that you're using your funds wisely, and, that you're attracting your good investors. So if you have all these things, you know that you're doing all these things correctly. So the other thing and that we need to talk about is having too much debt. So we talked about fundings, but entrepreneurs, like I've always said, they can rightfully be proud of themselves because they pulled their bootstrap up and they're on their way to success. They're the biggest risk taker, and they're want to make sure that they're succeeding. But we have to have the right balance. So in the end, the balance of what funds we have, whether it's equity or debt funding, whether we're taking out loans, we want to make sure that we have the right balance. So with whether you're getting debt for a vehicle or long-term debt, you need to understand the long-term effects and the short-term effects of your debt. You need to understand how your debt payments every month affects your cash flow, because the debt payment might not necessarily be all an expense. You might be paying for an equipment, or you might be paying for a vehicle, or you might be paying your mortgage for your warehouse or your office, so which is not an expense, but it's part of your cash flow. So that's why the cash flow is important, and it's not just your income statement or your profit and loss. So you want to make sure that we're going to go into 4 different ways that you can, steps that you can take to minimize your business debt and understand, paying your debt back on time. And you want to make sure that you are understanding that, the right debt that you're getting, you're understanding how your debt affects you, how to understand the payments, how the payment of the debt affects you. And, you also want to understand how it affects the health of your company. So, sometimes you would hear, like when I am watching CNBC or Fox Business News, I always think about the health of a company. So when you want to, most investors, they look at the balance sheet and income statement for the health of a company. If you have a large amount of liabilities, which is your debt, and you don't have the asset to help with it, or you don't have the forecast of earnings to be able to do that, then banks are not going to want to give leverage to you, and you're not going to be able to have a better cash flow going forward, because people are not going to want to invest, whether it's debt or equity that they're putting into your company. So you want to definitely make sure that you're looking at all of these things, all these bad money habits that we tend to develop along when we're working with our company. And we're going to discuss all the bad money habits. We're going to discuss what they are in detail, and then we're going to discuss solutions for them and how we go about making sure that we're following certain steps to make sure that we, are not keeping these bad money habits. And if we do keep them, how to make better money choices for our business. So again, this is Sherron, the Modern Savvy CPA, and I thank you for listening and watching my show. And stay tuned for bad money habits in a business and how we can avoid them. Thank you.